It's Friday, February 10th, 2023, episode 206. I'm Kevin Muir. This week is an interview-only show, but don't fret. We have a guest that's better than anything Patrick and I could ever come up with. We have the pleasure of welcoming back Will Thomson from Massif Capital. We have a wide-ranging discussion about ESG, political constraints, and the problems and opportunities that arise from the transition of our economy into one less dependent on fossil fuels and more reliant on renewables. Will shares his top picks, and you don't want to miss the end to hear what has got to be the most interesting Huddle guest hobby we've ever encountered. Let's just say this episode is not just lesson for investing, but a lesson for whole life. All right, then, let's jump to the interview. It's our great pleasure to welcome back to the show Will Thomson from Massif Capital. Will, it's been a couple of years since we've had you. Thanks for coming back.
Yeah, thanks for having me. Been a long-time listener since I joined the podcast, so excited to be back.
Yeah, it's great. And for those who don't know, Will was on the show a few years back. Go back and listen to it. You'll hear all about his fascinating backstory and all that. But today we're going to focus more on, instead of learning about Will, we're going to talk about what he's thinking these days and go through kind of his thoughts about the market. But one of the things before we start, I thought it would be great for me just to read what Massif Capital is all about. And I'm just going to quote from one of your recent presentations. It says, at Massif Capital, we thoughtfully allocate capital to businesses that are cognizant of how to best advance towards decarbonization in sustainable ways. We are focused on creating a portfolio of businesses from within the energy, basic materials, and industrial sector that balance the environmental and economic realities of achieving a carbon neutral economy. But throwing money at the problem will not make it go away. Almost every economic activity carries some sort of environmental cost. The question isn't about finding activities that are cost-free and supercharging them with excessive investment, but rather identifying the opportunities that maximize the associated social and economic benefits while minimizing the environmental cost. We must be intentional and discerning when investing in decarbonization with the hope that the return on investment will continue well beyond 2050. I love that. I think it's great. I'd love to hear kind of your philosophy, how you invest and how you see the world in that with that background drop.
So I apologize. I've got some noise in the background from the yard people, so let me know if it becomes a problem. Every time I get on a podcast, the guys who clean our yard seem to show up for some reason. I think, look, we started Massif Capital, or at least I started Massif Capital as a result of this time I spent in insurance, writing credit and political risk insurance policies. And it was all for, mining businesses and energy businesses and steel companies and sort of, what some people might refer to as the old economy or the foundation of the economy. But they were just sort of underappreciated, it seemed like. Admittedly, industrials, everybody invests in industrials from time to time, but energy and mining in particular seem to be much less paid attention to despite their criticality. And because of that sort of lack of focus, there seemed to be a lot of sort of surface level ideas about how the system worked and operated and how easy it would be to transition it. And the reality is, and we've started to see this already in places like Europe, it's not nearly as simple to replace the foundation upon which a house is built as it is to sort of start fresh when you build a new foundation. And so what we see like all the time is these efforts to tear down fences that have been put up without ever sort of questioning why the fence was put up in the first place. And from an investing perspective, that creates sort of two opportunities. One opportunity is, the fences that are being taken down, things like oil and natural gas, there's a spring that's just getting more and more compressed as more and more effort is made to divest of those assets. So there's greater importance in existing assets. And then the other opportunity is in sort of the growth that comes along with the transition. So there's, opportunities in the old assets as they grow increasingly more important and as scarcity starts to take effect. And there's opportunity in the growth in sort of new tech and renewables and all sorts of stuff going forward. So there's just a lot more going on and a lot more opportunity for an introspective and nuanced look at the energy system and the metals system and the foundation upon which the economy is built than I think a lot of people uh, realize. And the other thing I'd say is that these industries that we invest in, all sort of real asset industries, are a lot more complex and innovative than people often think. So you talk about mining, and a lot of people just sort of say, okay, we're digging a big hole in the ground. But it's not nearly that simple. It's not just, oh, we found a copper deposit, let's dig a hole. The hole's got to be the right shape and size, and processing the metals has got to occur in the right way, and there's a lot of complication and nuance to these supposedly simple industries that makes them really fascinating to study and makes them very hard to innovate in.
Right.
But there's a big effort to innovate in all of them right now, and so they're quite interesting to be focused on.
Okay, so you invest in kind of like two streams, I would say, or at least you highlighted two streams right there. You talked about the old commodities like energy that are getting starved of capital, and there's investment opportunities there. And then you talked about the new ones. Let's just start with the ones that are being starved of energy. And your background is politics. I'd love to just kind of get your opinion about what's driving this in terms of the lack of foresight from our politicians in terms of understanding that you can't just simply flip a switch and turn off, the infrastructure of how we've operated our economy for so long, and just talk about ESG. And I would just love to hear your kind of thoughts about this whole process of how we've gone about trying to get rid of the old fossil fuels.
Yeah, so that's a great question. I think that so the transition and ESG should be looked at as two separate things.
Okay.
So on the ESG front, which is sort of the easier one to deal with, I think, look, how do you allocate capital in a thoughtful way in line with someone's sort of personal beliefs, right? Like everybody's got capital in their retirement funds and whatnot, and they're looking to put it to work. Okay. And look, some people are just in it for returns, and some people are in it for more than just returns. And, as someone who manages capital, outside capital for other people, I've got to take those considerations into account, as do many other people. So how do you address environmental concerns within the constraints of capital allocation and investment and retirement funds? I don't really know how you do that at scale. Okay, so someone like BlackRock and their ESG ETFs, like I personally don't want to buy it. I think that when you do buy it, you're probably paying up for something that you basically get the same thing for if you just buy the non-ETF branded version. But addressing some of those social, environmental, and governance concerns at scale, I don't really know how you do that other than this somewhat simplistic route way that they do with an ESG index that really doesn't tell you much about anything.
Right.
So, I don't know how you solve that problem. But I will say from an allocation perspective, when you have time and energy to focus on the investments that you're making and the stocks that you're picking, ESG writ large, sort of ESG, Wall Street ESG, just immediately doesn't make any sense.
Okay.
It all occurs sort of after the valuation process, despite the fact that a lot of these variables are critical in evaluation. And then there's a lot of this discussion about stakeholders and things like that. And there's a juxtaposition of, say, a Milton Friedman like idea of shareholder return, and that's what the business should be focused on, versus ESG sort of stakeholder concepts. I find that juxtaposition a bit of a red herring.
Okay.
And maybe I find it a red herring because for the businesses I invest in, it quite clearly is. So, for example, you look at a mining firm cannot produce returns for shareholders if it does not take into account the concerns of citizens, if you will, who live in towns around its mine, right? So in order to get to shareholder returns, you first need to take into account a lot of these variables. So the idea of stakeholder capitalism or things like that, I find it to be a bit of a red herring.
Okay.
On the more sort of policy front, people get really emotional about it, and quite a lot of people almost view it in a moral perspective. We don't view it quite that same way. If we as a society decide that, decarbonization is a worthwhile goal, and I don't see any reason why it isn't, then pursuing decarbonization makes sense.
Right.
But it does need to be sequenced properly. And that is where I view sort of the biggest shortcoming right now.
And can I just interject here?
Yeah.
When I read your research, when I read what your firm is about, I was immediately struck by here are some guys that actually want to achieve the end goal of making the world a better place from this, but understand the reality, the constraints that we're faced upon, and are trying to allocate capital in a way that makes sense from both the shareholders and also society's point of view. Am I wrong that that's kind of
I mean, that's what we strive for
right?
sure. And I mean, it takes the shape and form of things that confuse people. And so, for example, I would say that oil and natural gas investment is critical to a transition to a low carbon economy.
Okay.
Absolutely critical. And it
Okay,
is
let's talk about that. Let's talk. Why is that?
is absolutely critical because, first of all, we need an economy that is humming in order to transition, right? You want to replace the entire electrical system? Great. Sounds good. You want to replace the electrical grid? Great. Sounds good. In order to do that, we need a lot of capital. We need, all sorts of assets and resources. All of those things cannot be achieved at the moment without oil and natural gas. Now, someday, maybe we can go to a copper mine and mine copper without using any oil and natural gas. But at the moment, we can't. Okay. And it's even more than that. That's a one-off case. But you look at, say, the chemical industry. I look around my office here. I probably don't have anything in my office that some chemical hasn't touched at some way, shape, or form in its production. All of that is going to be hydrocarbon based, right? So there's sort of this idea of trying to get rid of hydrocarbons. But before you've figured out how you can do what it is they do for us as a society, how to replace them, figure out something else that can do that, you still need to invest, right? So until you can produce all the chemicals we use hydrocarbons for without using hydrocarbons, you better continue to invest in hydrocarbons. Otherwise, you're going to bring the economy to a grinding halt. Now, I think, people are starting to recognize this, and you saw, or you may have seen, last night, President Biden gave his State of the Union address, and he said, look, we're going to need oil for another 10 years. Now, I think we're going to need it a lot longer than that, but that is very much the case. It is absolutely critical. And if you can't have a humming economy, then all these giant, massive capital investments that need to occur in order to replace one foundation of your economy with another, they simply can't occur. Unless we have spare capital to devote to these things, you just can't do it. And in order to have that capital, you need energy. And so hydrocarbons are critical to the transition. At some point, they may not be, but right now, they absolutely are. And any effort to just get rid of them without figuring out a way to use something else in its place is just short-sighted.
Yeah, I think it's insane. Like we're going to electrical cars, but then they're telling us at the same time to turn off our air conditioner in the summer because we don't have enough electricity.
Well, I mean, I thought the best rug pull last year, and I don't remember if it was Switzerland or Austria. I don't remember which, but they rolled out at the beginning of the year a bunch of incentives to buy EVs. And of course, because of the unique energy situation in Europe right now, by the end of the year, they said, well, you're not going to be able to charge your EVs at these specific times of day.
Right.
And so it's like, what are you guys doing? We need to get around. We need to do things. We need society to operate. And you're telling us, you're pushing us on one hand and then pulling it away on the other. Like it doesn't make any sense.
Okay, so let's talk about your strategy in investing on that side of the equation, because I'm assuming, given the fact that all of the Larry Finks of the world have withdrawn capital from the fossil fuel side, all of a sudden these industries are returning more for shareholders. How have you looked at it? What have you tried to do on that side?
Yeah. So on the oil and natural gas side of things, we've mostly stuck to E&Ps, sort of pretty far upstream, if you will. That's where we play a lot. And we've taken a bit of a barbell approach, where we've invested in some majors who have, strong production profiles, and are considering transition risks, if you will, and thinking through how they as a business will survive through multiple cycles,
Okay.
and then have paired that with more junior explorers, oftentimes in emerging markets. And those are going to be pure capital appreciation opportunities, and the majors are going to be sort of a capital appreciation and a capital return perspective. But what I will say is that we made those investments in 2019 and 2020. We reaped the benefits in 2021, 2022, and now are in a situation where when we look at oil and natural gas in particular, we think it's in a really tricky place.
Okay.
And the reason we think it's in a really tricky place is because a lot of money has flowed in, a lot of people have made good returns, and the companies are all sort of priced to perfection, in our opinion, for, let's call it this 70, 75, 80, $85 per gallon, per barrel oil. And
Okay.
so when you look at the equities and you say, okay, well, where is my next bit of capital appreciation going to come from? It oftentimes at this point is just commodity price appreciation. And for us, we don't really like to make bets that are, say, pure commodity price appreciation bets. So unless we can find some oil and natural gas assets that are either, someone's turning on an asset or they've figured out some way to reduce their cost, we find right now to be a particularly tricky time because everything just looks like a one-way bet on oil prices. Now, there are some companies returning capital, obviously, but oftentimes that capital return isn't necessarily sufficient in our mind to offset the potential fall in capital should oil prices slide. Now, why might oil prices slide? Well, long term, we're quite bullish. But in the medium to short term, with the economy where it is, we do have some concerns. Now, demand for oil is not terribly price sensitive, but the price is quite sensitive to demand. So if we enter a recession and we see, say, 2 million barrels per day on 100 million barrels per day global base, let's call it, fade, you could easily see oil fall back down to 40 or 50 or something, in which case, entering oil and natural gas equities here would be painful.
So I think.
It's tricky.
Oh, sorry.
Right?
So I think that's a great segue into kind of your framework. And one of the things I'd like you to do is highlight your experience with Barrick Gold, because you mentioned that you don't like just betting on the price of commodity. What you're looking for is betting on a particular situation. And Barrick was one where this happened. And you talk about the reasons you went for it. It wasn't because you thought gold was going up. You thought there was other catalysts and other factors that were going to make your investment profitable. Could you talk to us about that experience and maybe how it works within your framework?
Yeah. So I think, with our framework, you're sort of very much presented, I think, with two approaches to investing in equity markets often. And obviously there's many more than this, but we think about there as being sort of two approaches that we think about. One is sort of buying good things, and the other is buying things well. Okay. And these are very different sort of philosophies. The buying good things philosophy would be something like very sort of classic Warren Buffett style. Something is going to compound. You can buy it at a reasonable price today, and the expectation is that they will reinvest capital at high rates of return. They'll be able to make profits through cycle and grow their business that way. Okay, and so that's one way of looking at sort of equities. Now, the challenge with the cyclical industries that we invest in within the context of that sort of framework is that cyclical companies, by and large, make all their money at sort of certain points in the cycle. And unless you're invested in those certain points, you're not really buying a good thing. And so we end up mostly spending our time trying to buy things well. And Barrick Gold is sort of an example of that. So Barrick in 2018 was trading down at sort of like $10 a share, and it was bombed out. They'd had a long and sort of torturous experience folding in a couple of acquisitions that they had made in the previous cycle. The balance sheet was a bit of a mess, and the management team had brought in this investment banker from Goldman Sachs with no obvious mining experience to run the business. And the market really didn't care for that. So it was trading down at $9, $10 a share, well below the net present value of the assets at less than spot gold, and assuming no gold price appreciation. And so basically you had an opportunity to buy it well. It didn't matter what was going to happen to gold in theory, because the assets producing the cash flow that was being produced by those assets was worth more than the current share price already. So we didn't need gold to appreciate. What we needed was the management team to execute on a plan that they had articulated. And so our bet was on management executing a plan within a time frame, and that being sort of a catalyst to appreciation as opposed to the commodity price. Now, the commodity price happened to work with us also. Now, that's an even better situation where we have not only a bet that is quite clearly defined as a bet on management, but their revenue and profit margins increase as a result of something else in entirety, commodity price. But usually we like to just bet on that sort of situation. And again, we think about it as trying to buy things well, as opposed to just trying to buy good things. Because again, unless your timing is perfect, odds are you're not buying a good thing when you're entering cyclicals.
All right. So one of the things in this Barrick example you went on to talk about the three types of management teams: the non-conformers, the shapers, and the timers. Could you give us examples of those and tell us what you mean by those three?
Yes. Sorry, you're dating me a little bit, and we do think in this framework. But so, non-conformers, and you'll have to maybe remind me of each one as I go through them. So the shapers are companies that are large enough and have an acquisitive enough management team that they can literally shape the supply side of a demand and supply curve, if you will. And so the example I can think of is something like Kazatomprom in the uranium industry. So okay. Kazatomprom produces, the last time I looked, 30-40% of global uranium. Okay. That is enough that, depending on how they wanted to, what they wanted their production profile to look like going forward, they could shape the market.
Okay.
And drive prices up and down. Now, with uranium, it's not quite as robust an opportunity because it's not a terribly liquid market, but that's the general premise. The gold industry is far too diverse, for far too many companies for any single company to get to that level, but that exists in a lot of niche metals. The non-conformers would be people who recognize sort of my previous statement about, there's a period of time in the cycle in which you sort of make all your money. And then the rest of the time you got to be preparing to take as much advantage of that one period as possible. I think Barrick Gold and Mark Bristow, who's the current CEO, they may fall into that category a little bit. Mark Bristow does not seem to have any trouble going out and sort of buying or building an asset at any time during the cycle. And that's critical, in our opinion, to the success that he had first at Randgold, and probably critical to the success he hopefully has going forward at Barrick. Just the willingness to put capital up, even if the situation looks bad, recognizing that the cycle will turn.
All right.
And then you've got the occasional sort of through cycle management team. And there aren't that many examples of that. ExxonMobil would be the type of company that, in theory, has a through cycle management team where it just doesn't matter what's going on. They just plow forward with the strategy. And the strategy is devised with no consideration whatsoever of the commodity cycle. There are very few companies within, say, real assets and natural resources that can afford to be that type of business, but every once in a while they come around.
And when you're thinking about your investment style in terms of your allocation of capital, do you have a preference, or do you just say, if the price is right, I'll invest in any three of these?
So we invest in any of them. I think that, I don't think we have a preference. And we definitely don't avoid one type or the other. I think the non-conformer is a little more appealing to our contrarian perspective, but the challenge with non-conformers is that oftentimes, you want to buy it when they're doing stuff that the market thinks is crazy. And so it might be a little bit of a wait, and it might be a little painful to own. But
do you have any of those in your portfolio now that you're willing to share? Something that the market is not, you feel the market is not seeing through properly?
I mean, I've got things in my portfolio I don't think the market is seeing properly, but maybe not for that sort of nonconformist reason.
Okay.
The exception, actually, you know what? Well, one exception to that may be something like Equinox. Equinox is a gold company. I think you're familiar with it. I think we've talked about it before. Look, we made a great investment in Equinox a couple of years ago. It rocketed it up to 15. We said we thought there was a little more, and just as we said we thought there was a little more, it proceeded to collapse 70%. So this isn't
you goochered it. You goochered it.
This is not an example of like our best portfolio management ever. But I will say at this point, looking at Equinox, looking at the company the management team is building, looking at the fact that, by 2025, 2026, they're going to be doing 1 million ounces a year, up from 0 ounces a year in 2018. They've had massive capital return the whole time. It's a business that I don't think the market is really looking at the fundamentals and really considering. And they're in the midst of a CapEx cycle that's quite large. So I'm not sure it's, counter cycle, because gold is doing, or at least has started the year off pretty well. But it's kind of counter cycle, maybe a little bit.
Okay, let's talk a little bit about real assets, because you seem to definitely have a tilt towards real assets. Why don't you tell us why you feel they're important for a portfolio and the opportunity that kind of arises from that asset class? Why don't you tell us how you define real assets? Because I think that yours is slightly different than maybe some others.
Yeah, defining real assets can be tough. I think the traditional, let's call it Wall Street definition, is commodities, but not commodity companies, literally so like copper exposure, gold exposure, infrastructure, energy infrastructure, and real estate and tips. Now, tips is, of course, highly, well, it's most certainly not real. They exist digitally, but oftentimes people include tips in the real asset bucket, and that should tell you something. What it tells you is that people think real assets are good inflationary hedges. The reality of that is actually a little more mixed than people realize. Sometimes real assets work well as a inflation hedge. The reality, of course, is, though, that the only real inflation hedge is earning a return that's higher than the inflation level, however you can do that. So
that's a great line. I've never thought about it that way. That is really, you're absolutely correct.
Yeah, I mean, the only, at least from our, because look, sometimes gold underperforms. Sometimes, sometimes commodities just don't really hedge the inflation particularly well, or it's just it. When you dig into the details and you look at different inflationary periods, different things have done well, and it's really hard to say just like writ large real assets have done well.
Right.
So yeah, just try and get a better, higher return than wherever inflation is. Um, we define real assets slightly more broadly and in some regards more narrowly. We don't include tips. We don't include real estate. I don't know the first thing about real estate. There are a lot of experts for that, so you should go to them. We also are mostly focused on equities, and so the businesses that are producing real assets. So businesses producing commodities, businesses producing energy, businesses producing the durable goods that are either used in the process of producing natural resources or are utilize natural resources as their primary input. So we are all the businesses and the infrastructure associated with the more traditional real asset categorization of commodities.
And why do you feel that those are a more attractive asset class to invest in than, let's just say, a software company?
I'm not sure it's a more or less attractive question. It's just a very different return profile with a very different set of questions that have to be answered. And I would say that, and a very different duration on the assets and the investments. And so there's just different economic periods of time in the economic cycle where our assets are going to outperform those assets, and then the rest of the time we try to outperform again by sort of buying well.
Right.
So it's not an that or this, this or that. Our product, if you will, our portfolio, outside of for myself and my partner, it shouldn't be, for me, it's 75% of my net worth, if you will. It shouldn't be 75% of anyone's net worth other than mine. It should be a slice of capital. It should be allocated to the foundation of the economy because they're productive assets producing productive cash flow streams. And a lot of times you don't get that same return profile from software companies or tech startups or stuff like that. It's just a different return stream, and there's more dividends in it also, so there's more yield.
Okay. One of the things that I saw that we're going to start talking about specific stocks, and one of the things that I saw mentioned in one of your research pieces was the Lassonde curve. Can you explain to us what the Lassonde curve is and then how it works into your investing framework?
Yeah, so the Lassonde curve, or Lassonde curve, is it's an example of a sort of life cycle curve in mining in particular, but we believe we see it quite frequently with basically anything new that comes to the market. And so the idea is roughly as follows. You've got someone who comes to the market with an idea, and they're developing the idea, and they raise a little capital, and they go public. Okay, great. Then the idea makes a breakthrough, and when the breakthrough occurs, the stock spikes. And in the case of mining, it's a geologist has an idea. They come to market. They get some capital to drill. They drill. They find a resource. The stock goes up from whatever 2-3 cents a share to 25-50 cents a share, something like that. So it's a very large bump, basically value creation via the drill bit. Okay. Then everyone looks and says, oh, this looks great. But now we need to build a mine. Okay. And so now it's not just an idea. Now it's a business that needs to be created, a project, if you will, that needs to be executed. And so there are new risks. And with those new risks and with the time associated with that build, people say, man, we don't want to own this anymore. We'll get out. Okay, so now the stock fades just as you're starting the process of de-risking project development. and beginning the process of building the project. And so then you have a period of time where the stock is kind of in an orphan phase. Nobody's particularly interested in it. It's probably just trading with the commodity. But in the future, they're going to turn on the asset. They're going to turn on the mine. They're going to produce the new product, whatever it may be. And so you have a very firm catalyst in the future. And when that catalyst hits, what we find with mining firms in particular, but natural resources businesses and a lot of businesses, is that when you decompose sort of the results, what drove the stock at that point is not the commodity price in the case of mining, or in the case of oil and natural gas. It's actually turning on the asset, right? So all of a sudden the company has revenue, it has profits, it has margin, et cetera. And so we like to make a bet in the orphan phase about the company turning on the asset, because right there we have an opportunity to make a bet on something we can really due diligence, which is the operational execution and the ability of the management team to basically turn on an asset. This is very different than, say, someone going and looking at Freeport-McMoRan and saying, I think copper is going to 6, so I'm going to buy Freeport-McMoRan. Well, you basically just sort of said there that for all intents and purposes, you don't care what the company is. Your primary concern is that the commodity is going from whatever it might be, $3.50, $4 a pound to 6. That's your bet. Our bet is that management is able to build the asset and turn it on. Now, after they turn it on, it's probably mostly going to just trade with the commodity, whatever the underlying commodity is. But that process of turning it on is a catalyst that takes it from trading at, let's call it, 0.2, 3, or 4 of NAV to 0.8, 0.9 of NAV. And if you happen to turn it on just as the commodity is also running, well, then you go to 1.2 of NAV. But either way, it wasn't the commodity that was the primary mover. We're always laser focused on being very clear about what it is we are betting on. And the Lassonde curve and sort of understanding where companies are in their life cycle, and this applies across the board, whether it is software or mining, understanding where in a company's life cycle it currently is critical to sort of understanding really what it is you're betting on.
So I didn't realize. So I've known about this curve for a while in terms of just the life evolution of like a Vancouver stock promote. I've seen it for years. And my father was a research director, so I'd heard about this. And I knew about it, but I didn't realize that it was actually named after Pierre Lassonde, I'm assuming, and from Franco, Nevada.
Yep. Yeah.
And so he's got his own. I guess if you buy yourself an engineering building at U of T, then you also get a curve named after you.
Yes, it does seem so. He's a big name, and I guess Franco, Nevada is obviously sort of the first streamer, if you will, and definitely the biggest. So he's got some.
He's a wonderful guy, and he deserves to have a curve named after him. All right, so let's talk about stocks that are in the orphan stage, or maybe even just getting out of the orphan stage and are going to that startup stage where the value is starting to get realized. What are some of the names that you might have in your portfolio today that are at that stage?
Yeah, so we've tried to be pretty eclectic in our picks, and so I'd say at the moment we've got a trio of somewhat interesting mining firms out of Australia that are probably worth talking about, only because because we think there's a nice return potential, but also because they're all three of them are actually in different stages, if you will, along that curve, and so are quite informative. We've got a company called Adriatic, ticker symbol is ADT. Adriatic has a polymetallic, primarily silver deposit in Serbia right now, and that mine is very close to the end of the Lassonde curve, if you will, right before it inflects up and becomes a producing asset.
Okay.
So they're going to turn on their mine, I think it's later this year. Okay, and so we've already had a nice move from it, and actually it had a really big move last night that I couldn't explain to you. But it's trading at sort of like 340, 350 Australian right now. Is probably worth about $4 Australian. So there's a little bit left there. And right now you don't need to worry about permitting risk. You don't need to worry about construction. These things it's all well along the way. They're going to start to commission the asset shortly. And it's, if you're looking, silver is not usually a place we invest a lot in. And when we initially looked at the asset and looked at the business, they didn't characterize themselves as a silver company. But silver ended up just being the majority of the metal that they were going to produce. So it's an interesting sort of business towards the end of the curve. And so I'm not sure there's huge potential there right now, and the risks are probably more to the downside at this point, just given how close they are to turning on the asset.
Okay.
But there's a little runway left. Another one, sort of earlier, let's call it middle of the or sort of the front half of the orphan phase, would be something like Centaurus Metals. Centaurus Metals is also Australian listed, ticker symbol CTM. They are a nickel miner with an asset in Brazil that they are in the process of permitting. Most of the permitting is done. They're going to start construction, and they hope to turn on the asset in 2025, I believe. Now, what's interesting about this asset is that nickel can come in various different sort of qualities and characteristics. Some nickel is good for making stainless steel. That's the largest use of nickel in the world. Other nickel lends itself to being turned into the appropriate type of nickel for batteries. Now, the nickel that we're short of is battery type nickel. Finding battery quality nickel deposits is quite challenging. They've got one in Brazil. Most of these nickel deposits are in places like Indonesia. You've got some in Africa. So sort of Western-ish countries that can feed into U.S. and Europe, feed nickel into U.S. and Europe without touching China are limited and hard to find. These guys have a deposit that probably is going to fit that bill quite nicely. And so as they continue to de-risk the asset, we would expect it to continue to rise. And, right now it's trading at about $1.18 Australian. And our expectation is that, over the next couple of years, it'll rise to, we would think it would rise to something like 350, 360. So you're looking at, say, a 200% return from here.
Would that be kind of almost the ideal Massif Capital story? One
Yes.
that it's in the orphan, one that has a potential of commodity tailwind, one that's politically also from a kind of location standpoint also advantageous.
Yep. No, I think I hadn't thought about it in that particular way, but yeah, I would. It's a pretty perfect Massif Capital investment. Yeah.
All right, so that's a perfect example of a Massif Capital and kind of ideal stock. You mentioned the three. What was the third?
Yeah, so the third, actually, although Centaurus is the perfect investment, I think this one's actually almost a little more fun, if you will, especially from a research perspective. Ionic rare earths. It's earlier, and so I sort of discuss these in terms of time, if you will. So this is very early in the Lassonde curve's orphan phase, if you will. Ionic rare earths, ticker symbol IXR, out of Australia. So we obviously hear about rare earth metals a lot, but as with everything we've sort of discussed, you've got to dig into the details, right? And so when you dig into the details of rare earths, what you find is there are light rare earths and there are heavy rare earth metals, okay? And we need both of them. What's interesting, though, is that rare earth metals, generally speaking, aren't particularly rare. There is an exception, and that is the heavy rare earth metals. It's not that they're rare, but that the deposits are all in China and Vietnam, okay? And so rather than it being rare, it's more just sort of concentrated. Okay. And so the heavy rare earths are a problem for the Western world, especially because, in some regards, finding a way to get heavy rare earth metals that don't touch China is basically impossible. So you've got MP Metals in the United States, you have Lynas, which is an Australian company. Both these rare earth metal companies, they produce light rare earth metals. Okay, and there are different uses for them, but it's all mostly around magnets and things like that. Now, what's interesting about Ionic is they have found, as far as we can tell and as far as they can tell, the only heavy rare earth deposit outside of that China-Vietnam area. And it's in Uganda. And what's also interesting, so the scarcity value is there. What's also interesting is they've made several acquisitions along the way as they've sort of developed their plan for this asset, including various processing and recycling technologies. And so not only is Ionic Rare Earths going to build this heavy rare earth asset in Uganda, but they're also going to build a rare earths recycling and refinery facility in either Europe or the United States and create an integrated operation within heavy rare earths that you can't find anyplace besides China. And so they've got a bit more of the supply chain, if you will, than our usual investments. But it's kind of interesting because they've taken more of that supply chain.
All right. Now, you've touched upon it there in terms of China and Vietnam having those heavy rare earths. You recently wrote a piece about why you don't invest in China. Your background is politics. I'd love to hear your reason for avoiding that as an investment possibility.
So this is by no means like a universal statement, that you shouldn't invest in China. I think there's no such thing as you shouldn't invest in our mind, right? It's all a question of price and experience and things like that. For us, we lack the experience with China and specifically with understanding the Chinese system and with having confidence in management teams' ability to operate within that system to accept the political risk. So we think about political risk in a slightly different way than a lot of people do. What a lot of people talk about when they talk about political risk is more sort of like this concept of country risk, which is to say, is the economy strong? Is the political system stable? Variables like that. When we talk about political risk, we are thinking about the ability of the government or politics to have a direct impact on the business, make a decision, make a policy decision or something along those lines that directly impacts a business. Now, the way to address political risk of that nature is with a management team that's capable of maneuvering within the political system that it's operating in. The challenge with China is that unless you are in the club, and in this case, quite literally, in the People's Republic of China, the Communist Party, you're not in that system. And there's all this stuff that's occurring behind a wall that you have no ability to penetrate whatsoever. If you are not part of that club, you are not part of that club. And your sort of concerns are only taken into account if someone behind that wall decides there's a reason that's probably good for them to take into account your considerations. And so the ability of management teams to operate is what really determines how much political risk there really is, rather than, say, sort of this country risk perspective. It's more about operations and less about sort of like contextual variables. And so, again, in the case of China, unless you're part of the Chinese Communist Party, odds are you're not going to be able to shape the narrative and shape the discussion and shape the policy very much. And so as an outsider, it's twofold. A, I can't find management teams where I think they have access to the right people or to the system itself. And B, I myself can't look at a management team and tell you whether they really have the access and the ability. Because who's part of the Chinese Communist Party remains in many regards a state secret. It's not literally, but in many regards it is. And so China is particularly problematic because we can't evaluate the ability of management to handle the risks.
Okay, so China is an example of a country you avoid because you can't get a handle on terms of understanding or at least transparency about how it all works. What might be a country that at first blush looks like it has all sorts of political risk, but you actually feel that it's not as scary as the market might believe?
Democratic Republic of Congo.
Oh, yeah? Why is that?
Look, most of the issues in the DRC are corruption and violence. If there's any issue that is really easy to deal with as a management team, it's violence, right? You can literally pay your way out of that issue. It's just hiring the right security team to throw around your asset, or having an asset that's far enough away from everything that the security issues don't matter. We have one investment in a company called Alphamin right now, which is a tin miner in the DRC, and their asset is just so far away from everything that the security is just not an issue. So mostly the DRC scares people because it's a really violent place, and there's a lot of corruption. Those are relatively straightforward and easy issues for a management team to deal with. Everyone wants to do business in the DRC. That's not an issue. So finding people to work with is not a problem. Finding people to work with who have relationships with the government is not a problem. Getting to know the government and government officials is not a problem. Those are qualities of a country that enable a management team that's appropriately skilled to maneuver within the system. It's when you don't have that room to maneuver, when you don't know who's making decisions, that's when you've got political risk problems. So we often look at Africa as a place with pretty low political risk in the grand scheme of things. Certainly more straightforward political risk than, say, someplace like the United States, right? The United States has got plenty of political risk, but boy, is it complicated and difficult. You think about all that time, money, and effort spent on lobbying in the United States. Lobbying is political risk management. That's what that is. It's much easier to lobby in Africa for policies that work for your favor than it is to lobby for policies in the United States that work for your favor. Africa writ large, but the DRC in particular, I don't think has nearly the same political risk that people think it does.
I want to talk a little more about the political risk in the U.S., but first, let's talk about your tin mine company, because I know a lot of people. I've heard that name before. I believe the tin is one of those commodities that's difficult to actually mine, and there's not a lot of mines around, and that's one of the few. Am I correct? Can you just give us the story behind that company?
Yeah, so tin is, I'll just use the slogan that the Tin Association uses. It's the glue that holds all our electronics together. You flip over a motherboard and all those little dots on the back, that's all tin. Tin's got a whole bunch of other uses too, but mostly in electronics. The story with Alphamin is they found the world's highest grade tin deposit in the DRC. I don't think another tin deposit has been turned on for 10 years. The use for tin has historically been relatively slow growing, and the availability of tin out of places like Indonesia and Myanmar has been quite high because they had very rich deposits that have very long lives. Now, those assets are all sort of coming towards the end of their life, but tin is not a big enough market for someone like, say, Rio Tinto or BHP, if you will, to be involved in. So there aren't a lot of companies that have been looking for tin. And so you had this sort of perfect situation start to build over the last 10 years where the primary assets that have more than sort of addressed the market demand over the last 2 decades, let's call it, were coming towards the end of their life. No one's paying attention, and the market starts to get squeezed. Alphamin produces roughly 4% of the world's tin. It's the world's highest grade tin deposit. It sits outside of Indonesia and Myanmar and sort of that. They've got a bit of a tin cabal there. And so, the opportunity here when we initially invested it was pre-production. We then proceeded to hold it because the torque they have to the tin price because of their high grade is so significant, and the constraint on the supply side is so significant that we thought we'd get another pop out of tin prices. And we're starting to see that. They've gone from, they went from 40 down to $40,000 a ton to $20,000 a ton last year. They're going back down, or they're going back up now. They've crossed the $30,000 a tin mark. I think we'll see those 40 numbers again, but time will tell.
For those who don't know, what's the symbol?
Ticker symbol is AFM. It trades in Canada. I think it only trades in Canada.
All right. And there's an example, by the way, of something where you bought it originally for the orphan to the startup stage, and now you're keeping it because you want exposure to the commodity. Am I correct?
Yes. Yeah.
Now, one of the things you mentioned earlier is that the political risk in the U.S. is actually higher than people understand. Could you elaborate on that and talk a little bit about that?
Yeah, I mean, again, we have this divergent perspective of political risk, where it's a sort of the ability or the odds of government, if you will, fiddling in such a way that it impacts operations of a business. It makes the business more difficult. And in the United States, there's obviously and the developed world in general, Europe included, there's obviously a lot of government involvement and increasing government involvement in economics and in the day-to-day operations of businesses, because the regulatory perspective is one that goes every year. There seems to be an increase in how specific and how detailed the government wants to be in its involvement, right? It seems to want to drill down to a lower and lower level with each regulatory iteration.
Right.
And so, it can be quite high in the United States because you've got all this regulatory sort of infrastructure that exists. And for the businesses we're involved in, it mostly takes the form of permitting. But it is by no means limited to that. You look at something like Facebook and Twitter. Okay, Facebook and Twitter have huge political risk, and it's probably really nasty because I have no way of even thinking through what the repercussions of, say, regulating those two entities what it would look like, what it would feel like, what it would do to margins, foreseeing how they will be impacted by, say, some, I don't know, let's say the Republicans in the next 2 years, the next election cycle, maybe they take the House, or maybe they take the House, the Senate, and the presidency, and they decide that social media companies are bad and the enemy because they're too liberal, and they regulate them in some way, shape, or form. Well, that's a very real possibility. I wouldn't say it's necessarily base case, but there's a real possibility that these entities get regulated, and they're going to go from unregulated to regulated. And what that does to the business is anyone's question. You take Facebook and turn it into a utility. Well, that's a very different business than the current Facebook.
It probably needs a little bit of a revaluation, if that's the case.
Yeah, exactly. Now, in the case of the businesses we invest in, though, we have some really nasty development issues that tie back into sort of the discussion of this transition to a low carbon economy, where, as you noted, we have politicians who are pushing us in that direction, but they're only really sort of pushing. And the reason I say they're only really sort of pushing is because in order to really push for a transition, they need to make permitting of all these types of projects, whether it be mines or renewable assets, easier. And right now, there's no forward progress on that. You want to build, if you want to build a wind farm right now and get it connected to the grid, it's going to take you 5 years just to get it connected to the grid. And that's all because of various different permitting and political risk issues. So the political risk in the United States and in regards to permitting in particular absolutely hamstrings the progress towards decarbonization, makes it quite challenging.
All right, let's just finish up by kind of pulling back and looking at the macro environment from a little bit a higher level. And one of the things that I saw you recently wrote about was the fact that you thought that the era of disinflation was over. I'd love to hear your thoughts, why you think that and what that means going forward.
Yeah, I think so. We don't have an outlook where we think, say, we're going to have like 6 or 7% annualized inflation every year for the next couple of years or anything like that, or crazy hyperinflation. We do have an expectation going forward that there's going to be a lot of inflationary volatility. So literal volatility in inflation from one month to the next and 1 year to the next. And the reason for that is because we've had this extended period of time where there's been a lack of investment, a lack of infrastructure development for the foundation of the economy. And that takes the form of not only not investing in the building of mines or other assets that produce the critical inputs, but a lack of upkeep in a lot of the existing critical infrastructure, whether it be in Europe or in the United States. And then you've got a lot of infrastructure growth, if you will, in the developing world. And so you've got all these potential sources of demand bumping up against significant supply weakness. And so we expect to have these sort of pulses or waves of inflation ripple through the system as this or that good goes into shortage, driven by the supply side. And some years it's not going to be significant, and other years, China is going to incentivize the purchase of EVs, and all of a sudden, lithium is going to go from supply demand balance to nasty deficit. And because there's a time to build problem with a lot of not only infrastructure associated with these assets, but also time to build problem with, say, a mine itself. You're going to have periods of times where the price just shoots the moon and stays up there for a little while, and then starts to come down slowly as new assets come online and supply hits the market. But because that lack of investment is so widespread, and because this challenge we're facing with climate change and its transition touches so many different aspects of the economy, everything is being done at scale, and it's being done at global scale. And so that combination just creates a ripe environment in our mind for a lot of inflationary volatility as different shortages crop up and resolve themselves and then go back into shortage and back and forth like that. So we would expect inflation to settle at a lower price or at a lower level, but to have volatility as time goes on.
That's a fascinating way of looking at it. I really like that. All right, Will, it's time for our end of the segment questions. Now, in the past, we've already kind of done the three major ones with you, so we're going to do a couple of new ones, and we're going to start with the Don Cox question. And Don Cox was a Canadian strategist who believed that you shouldn't invest on what's on page 1 today. You should invest on what's on page 18 on its way to page 1 tomorrow. Do you have a Don Cox investment idea for us?
So I think that, I'm not sure if this is page 18, maybe it's page 10 or page 15 or something. I don't know.
Okay.
But I think emerging market and specifically South American renewable and electricity, renewable assets and sort of electricity development, electrical system grid development, I think those are underappreciated opportunities right now. Everybody's obviously rushing to sort of jump on, say, sun runs and sort of developed world renewables. But the fact of the matter is that South America in particular is a country that's ripe for further penetration of electricity. It's a country, or it's a continent that has a geography that lends itself to more distributed sources of electricity. And it's a continent that's ripe with renewable opportunity, whether it be sun, wind, or hydro. And so a company that comes to mind that's in our portfolio right now is Polaris Infrastructure, another Canadian listed firm, ticker symbol PIF. They develop sort of 100, 200, 300 megawatts, so small in the scheme of electricity, small renewable projects in South America. And the prices they get on their power purchasing agreements are multiples of what anyone in the United States or Europe gets. So I may get a PPA in the United States for a solar or wind project. I may be getting, $30 or $40 a megawatt. They regularly average PPAs with prices in excess of $100 a megawatt. And that's just because sort of the electricity demand is growing. The geography, again, it lends itself to renewable development. Renewables are very much a time and a place sort of asset as opposed to a universal solution to things. Some places they work really well, other places they don't. South America is sort of an ideal case of a developing region that is well situated for renewables and where there's plenty of growth opportunities. So, and PIF looks to be an interesting platform on which to build a diversified independent power producer focused on renewables in South America.
I like it. Don Cox will be proud because it's also Canadian listed. All right, the next question is, up here in Toronto, we have this DJ that used to be in a rock and roll band, and this kind of afternoon DJ, like a radio host, and he had a segment called Damn, I Wish I Wrote That, where he would pick a song and he would talk about it and play it and talk about why he wished he had written it. So we're going to do Damn, I Wish I Traded That. Do you have an example of a trade that you particularly loved that you didn't do, that you watched someone else do? It could be historical, it could be anything. Just something you really admire that you would like to share.
So this is a little different. A particular trade doesn't come to mind, but something, a skill, if you will, that I see a lot of portfolio managers or investors deploy that they're capable of, and that I wish I was capable of, that sort of, I think, fits the bill here, is this idea of having a core position and trading around that core position. Once I start a position and enter it, like thinking through, say, well, the stock's really moved. Maybe if I trim here, I can then re-enter and build it back later, and sort of make some money in this period where I'm waiting for my catalyst to take hold and I'm waiting for the full story to unfold. I really wish I see people who do that profitably. It's some sort of, and they're often old time market makers who used to work on the floor. But that ability to trade around a core position, it's not, a particular trade, but that skill set, I wish I had that skill set. I wish I could figure out how to do that, especially because a lot of the stuff we look at is quite volatile. And so the opportunity would seem to be there.
Well, it reminds me, though, of one of those things. I think I saw something about FX dealers at banks. And they looked at the amount of spread that they should be earning off of their flows, and then they looked at the amount they were also allowed to take positions. And it was when they looked back and they analyzed it all, they realized that their positions were actually losing money. And one of the things that I worry about is that, maybe you're seeing some times where guys are trimming and it's working because they're trading it around it. But then all of a sudden, there's the out of the blue catalyst comes early, and you're all of a sudden light on an idea, and there's nothing worse than not making as much money as you should have on a position that you had nailed from a research or a fundamental point of view, and then you got Q trading it. So I'm not sure that you should really be.
No, I mean, fair enough. But I think, fair enough. It's anything associated with timing is always very difficult.
So listen, we can't finish this without talking about the fact that you are the second coming of Mr. Miyagi. Why don't you explain to people what your favorite side hobby is and how you got into it?
Yeah. So Mr. Miyagi. I've forgotten that in the Karate Kid,
Yeah.
Mr. Miyagi grows bonsai. So I grow bonsai, which is a practice of growing basically little trees in a pot. And I started the hobby because I was looking for something. Look, the challenge with, or one of the challenges with investing, at least in my opinion, is it's just like all consuming. Um, it Everything can sort of feed into the process of investing. You read the paper on Sunday. Well, it's not just casually reading the paper on Sunday, right? It's, oh, there's stuff about energy, there's stuff about policy, so it's just this all consuming sort of thing. And anything I read, I feel like, is also associated with my investing. And so I was looking for a hobby that just had no connection whatsoever to investing. And somehow I sort of stumbled across uh, uh, bonsai trees, and I liked being outdoors. Most of the trees, or at least a lot of the trees I grow, are all capable of surviving the winters here in Charlotte, which are not terribly significant. But I will say that it's a very slow moving hobby. So I
It's
grow a
good for
tree.
your investment style.
Yes, it is good for your investment style. I think my I've got about 15 bonsai trees at the moment, and I got a couple more that are on the way, and they're all in various different stages of development. And it's interesting. You sit there, you grow the tree. There's a lot of sort of little day to day things you have to do, making sure the tree is properly watered, and every tree requires slightly different water, sort of watering regime. You've got to make sure that they're getting the right amount of sun, or too little or too much sun. And because you're trying to grow something in a pot, they're quite sensitive to the environment. A tree's not supposed to be grown in a pot, so it gets quite sensitive. And then you've got to make these sort of decisions about the long term also, where you cut a branch off, and once you've cut the branch off, there's great path dependency, right? Like you've only got the branches that are on the tree that are left, and so you have to think through, what do I want this tree to look like in 10 years? What do I want it to look like in 15 years? And so those are sort of the timelines. So there's just sort of some interesting decision making to be had, and little day to day activities that can sort of take your mind off the market, and it's all
How,
done with
how,
your hands
how,
and so
how did you
on.
start this? Like, is there a bonsai tree for dummies, like the yellow book?
Yeah, no, there's this great website called Bonsai Mirai that has an education platform, and the guy goes on, and once a week, I don't know how they produce so much content. Once a week, he does a live video cast
Yeah.
where he basically takes a tree and either repots it, because you need to change the pot that the bonsai are in every couple of years because the roots are going to grow, or he styles it. And he does this for 2 or 3 hours. That's how long it takes. And he walks you through the whole process, and every week he does this. And you go and you look, and it's the trees he's working on are, this guy in particular, he's one of the world's best bonsai artists. We're talking about trees that are 500, 600 years old. He's got a couple of trees that he doesn't know, but he thinks are 1,000 years old.
Oh
Right?
my goodness.
So you think about him taking this and cutting a branch off, and you're like, well, you just cut a branch off a tree that is, older than the United States of America, and I hope you cut the right branch off, because you're not going to be able to grow another branch there. And they all keep changing too, right? So once the tree has reached sort of its maturation point, it's good for 2 years, and then you sort of need to let it go again, and start the process all over again, and build a new design, because you can only keep the tree looking in a certain way for so long. So in many regards, they're kind of like businesses, right? They need to keep evolving.
That's fascinating. That is kind of the funniest and almost interesting side story we've had in a long time, Will. All right, so why don't we tell people about Massif Capital, where they can find more? You have a great website with all sorts of research. Where do people reach out and learn more about you and your firm?
Yeah, so you can visit our website, which is massifcap.com. And you can join our mailing list. We send out usually a couple of ideas a year, a couple of white papers a year, and there are a couple of blog posts and then our quarterly letters. So there's sort of like something to read once a month, maybe twice a month. So it's not too much, but so you can see us there and read our material there. And then I'm on Twitter. I think my handle is WM Thompson22, and I tweet couple of times a week, but I can't claim to be one of these people who's on there all the time. So every once in a while I'll tweet something interesting maybe, but not very often.
Right. So the main thing is go to Massif Capital, MASSIF cap.com. You can go sign up. You can get on the research list. You can learn more about the firm there. And Will, it's great to have you on. I really enjoyed that. It was a lot of fun, and hopefully we won't take as long to have you back.
Absolutely. Sounds good.
Thanks again.
Thank you.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please go give us a follow at the Market Huddle on Twitter. We're there every day, and Lena gets tired talking to Patrick and myself. You can listen to the Market Huddle on all of the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And if you could, please give us a rate and review us on iTunes. It's a dumb game, but it makes a difference to Apple's algorithms, and it helps us out immensely. Patrick can be found at Patrick Ceresna on Twitter, and you can also check him out at thebigpicturetrading.com. Listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. Thanks, everyone.